if you're good at raising capital. You don't have to pick up the phone and call a broker or seller ever. You don't have to go to a property unless you just want to. You could be elite at one part of that deal triangle, whether that's sourcing, operations, or funding. If you are elite at one of those three things, you can make a big pile of money in this business. You only gotta be elite at one. On today's episode, we are gonna do episode 1 of a 3-part raising capital series. Most importantly today, what we are gonna do is break 2 key myths. Myth number 1, that you need a lot of money to get into commercial real estate. You absolutely do not. Some money is very, very helpful, but you don't need a ton of your own money to get this done. Number 2 myth that we are gonna break is that you have to do everything yourself. And those two go hand in hand, and that's going to be the key thing that we're going to talk about in this episode. We will talk about raising capital a lot. It is something that I spend a lot of time on every single week as I'm trying to buy more and more commercial real estate deals. It's also something I coach students on every single week because it's a key component to getting these deals done. But we're going to start way back at the beginning. It's something really, really important, and this feeds into that myth too we were talking about. And I'm going to explain the concept of what I call the deal triangle. Now, this was developed by my good friend, Paul Sparks. He has got an awesome club that he runs. It's called The Club. It's based out of Denver, Colorado. If you live in Denver, you should 1000% hit him up and get involved in that group. It is for business owners in that particular area that are doing really well and want to network and work with other business owners of all types. A decent amount of people in that group are real estate focused, but in general, they just get together and talk about all the different things that us business owners deal with in a weekly basis. It is also open to national members. I'm obviously not in Denver. I've been a member for several years, but enough about Paul. His group is awesome, but this deal triangle is from him. I took it from him with his permission because I think it is such a simple way to explain a very important part of real estate. And this applies to all real estate in general. But I think when people get into single family and they're going to buy their first rental or their fix and flipper or whatever, these things are easier on smaller deals. So we're doing all of them ourselves. But what the deal triangle is, it's literally just picture a triangle. And there's 3 parts to this particular triangle. You cannot buy any single real estate deal without these 3 things. The first one, and the one that most people think about when they're talking about real estate deals, is sourcing. So you got to find a good deal. And most people spend most of their time on this part of the deal triangle. But it's important to note it's just one of the 3 parts. Now, what could sourcing mean? In the standard residential world, sourcing could be as simple as just finding the property on the MLS or on Zillow. For example, we'll go through the deal triangle for my very first buy and hold duplex that I bought back in 2018 just for myself. How did I find that deal? I found it browsing Zillow and MLS. I did have an investor-friendly agent I was working with at that time that we went and looked at properties together, but that's how I sourced deals. I didn't have some big marketing budget or big team. I just found that deal myself. So I did that part of the deal triangle. The next part is operations. So obviously you can't buy a deal and completely ignore it after it's purchased. So there's an operations component to this game. Everyone thinks about property management. Someone has to go talk to that tenant or tenants if it's residential. If it's commercial, we still have tenants. They're just more business type tenants in the industrial, retail, and office space. But somebody's got to manage them, make sure they're paying rent, handle their issues and problems, etc. And that's property management. Now, a lot of people think you just hire a property manager and you're done. But if anyone has ever had property management before, you absolutely understand that managing that manager is an extremely important job. And it's not necessarily easy by any means. So someone has to manage the property manager. In the commercial space, we call that job, whether that's handled by you, the owner, or an actual employee or person, we call that role asset management. So someone has to be looking out for that asset and making sure it is performing to its maximum potential at all times. The property manager is more focused on potentially filling vacancies, collecting rent, handling any tenant issues and concerns. The asset manager sits on top of the property manager and is checking those things as well, but is looking at the overall financial picture in more detail. How much rent is being collected? Can we maximize that? Are we at market rent? What are the expenses? Are the expenses at a ratio we're comfortable with, or can we reduce and cut those expenses in any way, shape, or form? Is the asset being protected? Is the roof strong? All those different things is the job of the asset manager. So back to my first rental. When I bought it, I was scared to talk to the tenants. I didn't have a property manager, so I hired a property management company. They handled that, and I quickly realized I had to manage them or they were going to do a bad job. I ended up firing the first property management company that I worked with because they were doing a bad job. But that was me acting as that second part of the deal triangle as the asset manager. Now, we mentioned finance, and finance is another critical part of operations in a commercial building. Financing includes bookkeeping, and someone has to act as the CFO, even if that's all those roles are rolled up into you as one person. It is still a role that someone is filling, actively looking at the finances and making decisions for the property and the project based on how the finances are doing. So that's two parts of the deal triangle we've talked about so far. This series is about raising private capital or raising capital. So I hope you can understand the third part of the triangle is funding. And so you cannot, back to the beginning, you cannot get a deal done without sourcing, operations, and funding. Those three things are critical to buying any commercial real estate deal, whether that is a $100,000 buy and hold single family residential property, a fix and flip, or a $100 million commercial deal. Just as you get into bigger numbers, those roles become more pronounced. So on the funding side, what is involved in funding? Well, every deal has something, it's a fancy term we call senior debt. But typically, this comes in multiple different flavors. If the building is already stabilized, we're going out and getting, a lot of times on industrial retail office, local or regional banks are providing commercial loans. These are DSCR products, so they're debt service coverage ratio products. So the rent has to be here, and we can afford a mortgage here. That ratio is typically 1.25 that banks are looking for. So if you have a stabilized product or a reasonably stabilized product, you can go get a loan like that, and it's going to have the best interest rates in the commercial space. If you have a less than stabilized product, we are getting what's called a bridge loan. Sometimes people refer to these as hard money loans. But these are higher interest rates, but people are willing to lend on properties that need a little bit more work. Same thing applies. You have to have a business plan. You have to show them what you're doing. You have to be experienced or familiar with the product as much as possible. But that is another way that we get lending done on these commercial deals. And the third way, my favorite way, but something we don't get every single time, is seller finance. So we love doing seller finance deals. We ask every single seller that we work with if they would be willing to do seller finance. The reality is not all of them can. Some of them have their own mortgages they have to get out of. Some want to 1031 exchange their money into something else. But a decent percentage of commercial sellers compared to residential at least understand what seller finance is. And it's a bit easier pitch for them than it is for a residential seller who's never really heard it before and doesn't really want to take on that risk. So we go get our senior debt or primary debt. That is a part of funding. But the other more important, if you will, part that we're going to talk about over this 3 series is the rest of the portion. Because if you go get a bank loan, they're only going to want to cover 75 to 80% of the purchase price. And they're certainly not going to want to cover their own fees. They want you to have skin in the game. They're typically not going to cover your rehab. Bridge loans a lot of times might, but not always. And so you've got to find money for a down payment, closing costs to both the lender and your title company or closing attorney, something that we call pursuit cost. So things that you have to fund in the process of buying the building. So that's things like environmental surveys, appraisals, regular surveys, and different various things that you're going to need prior to close. And then your rehab budget, your construction budget, if you have one, also needs to be funded. So let's give an example. So let's say you're going out and buying a $1 million property, just to keep the math easy. So your primary lender may fund 75 to 80% of that. And I find it's in that range. You can get 80 if you want 80. A lot of people would prefer 75, but 80 is out there. It's definitely achievable for a lot of these deals. So let's say you do get 80, you get a lender to fund $800,000 on this particular deal. So what do you have left to raise? Well, you've got that $200,000 down payment. What else is there? Closing cost. This is not the easiest thing in the world to estimate. Some people will tell you 3% of the total purchase price. It's not a bad starting point. In general, I've done this size deal many, many times. I'd venture to guess you're going to be somewhere in the neighborhood of about $25,000 to close. That's a mix of whatever points or origination fees you're going to pay the lender, documentation and other miscellaneous lender fees. You're going to pay for title insurance, which is a big one. You may pay transfer taxes and general closing costs. All that said and done, it's a lot of different fees you get nickel and dimed on. I think in the $1 million range, 25 grand is a fair guess. Pursuit cost, I'm going to just label that as 15 grand. You might be able to get away with 10 grand in a property, the 1 million range, but 15 grand is a reasonable guess. So what else is there? So your rehab budget or your construction budget. Let's say you walk this property and you feel like it needs 100 grand worth of work. I think that's pretty safe bet for a property this size. The biggest thing you need to be careful for, and we'll do a whole podcast on this series, is your roof on properties this size. A really rough roof could need upwards of 100, 200, 250 grand worth of budget just for the roof on a building this size. So typically 10 to 20% of the entire purchase price is going to the roof. So we check every single roof, typically with multiple different roofers before we are buying the property. So that is something to absolutely make sure that you're handling. So far we got 200 grand down payment, 100 grand construction cost, rehab costs, and then 40 grand in both closing costs and pursuit costs. So we're up to 340. Is there anything else that we might need in this scenario? There's two other things that I think you should budget for. One, you absolutely need to budget for a reserve. What is a reserve? We need to have some money set aside in the bank account for the LLC that's going to buy the building for if things go wrong. Even if it's fully occupied, what if a tenant leaves? What if multiple tenants leave? What if something breaks that you're responsible for as the owner? And typically, on a perfect world, I'd love to have 6 months of reserve at close, but maybe 3 months more realistic. Regardless, in this particular imagined scenario, let's say you want to have 25 grand set aside as a reserve. Now we're up to 425. What else do we need? Well, if you're raising someone else's capital, which we'll talk about over multiple podcasts, you and or your team, or like if you're like me, maybe you have a sales guy who's out there calling leads, talking to sellers, talking to brokers. If that person found this deal, they deserve to get paid for finding this deal. So that's called an acquisition fee. And we are adding that typically to most of our deals. And the vast majority, if not all of that, goes directly to the person who found the deal. And that number on a deal this size, anywhere around 5% of purchase price, can be upwards. I've seen industry standard all the way to 10% of purchase price. For a deal like this, I would say that's somewhere in the neighborhood of $25,000 to $50,000. So we'll just call that $50,000. And overall, to purchase this deal, you're going to need to raise at least $475,000. So that just gives you an example of what this might look like. So I think we're going to keep this episode today short. We're going to go much longer on the next couple ones. There's a couple I'm going to end with this. The reason I wanted to spend time on the deal triangle is because newbies come to me all the time. They're like, how do I get into commercial real estate? I got to go mail and cold call commercial sellers. I got to learn how to operate these buildings and especially with something difficult like multifamily at a really high level. And I got to have 800 grand of my own money to put in the deal, or I got to be really good at raising capital and be able to go raise 800 grand. The beautiful thing about commercial is the deal size is bigger. This can be more of a team sport. You could be elite at one part of that deal triangle, whether that's sourcing operations or funding, raising capital in particular. If you are elite at one of those three things, you can make a big pile of money in this business. You only got to be elite at one. That being said, if you're not elite, it's probably reasonable to try to get good at two. I think most people make the mistake of trying to be good at all three. It's really, really difficult to be good at all three. I'm not sure I would call it a mistake per se, but we've been in the process and we do all three of those for our deals. But man, when I have a lot of deal flows coming in and a lot of deals under contract, or we're in heavy operating period and we've got multiple deals we're trying to stabilize, it's really difficult to do those things and focus on raising capital at the same time. So here's a beautiful thing. Take the pressure off and don't tell yourself you have to be good at all three. Just focus on one or two. If that's sourcing, awesome. If you already have a good network and you want to do the relational selling of raising capital, go get good at raising capital. And guess what? There's people like me all over who would love to work with you on their deals if you're good at raising capital. You don't have to pick up the phone and call a broker or seller ever. You don't have to go to a property unless you just want to. And you're certainly not fielding calls from tenants who are having problems and handling the stressful part of operating a building. If you're really good at raising capital, you can get in as many commercial properties as you want. And if you are good at it, call me. So let's leave you with some homework. Think about which one of those in the deal triangle you are already good at or you have experience with. Drop that in the comments, email us, share that with us on our social media. We'd love to know what you're good at. Think about what your superpowers already are and see, even if you haven't started this and you haven't done any of these three, with your current, what you're already good at overall, which one will be the best fit for you? And think through that, have a little think session on that. And if you are new and you're like, how do I get into commercial real estate? I don't have any money. I don't know how to source deals. I'll tell you, one of the things, I get this at local events all the time. There's new people all the time like, man, this sounds awesome. Like, I want what you have. I want to break into commercial real estate. I think it's really important that you bring someone who's already operating value of some type. No offense at all if you're new, but if you can't bring me any value whatsoever, it's really, really hard for me to partner with you in any way, shape, or form. And I've been in this situation a lot because we do coaching and all these different things. People will call me from different cities all over the country and be like, hey, John, I live in Houston. I'm a go-getter. I would love to call Houston deals for you. And we have tried that many, many times. The challenge is for someone who knows nothing, we end up having to spend a lot of time, myself or my sales team or whatever, coaching them through the process of looking at deals, underwriting, evaluating deals, and making offers. And so then we end up putting in, half of the work on the sourcing side because they don't know how to do it yet. And I get that, but it's just my sales team could go do that because we're good at sourcing. So finding ways that you do really contribute and add value, and you can be valuable to a potential partner. And so think through it through the lens of that deal triangle. Do you have a really good lender source that you could bring to the table? Do you have experience underwriting, and analyzing properties? Do you have experience running properties? Do you have construction experience? So think through what your potential strengths are and how you can add value to somebody else. Maybe it's just relationships. If you have 4 or 5 key capital partner relationships, that is absolutely a reason that you would be worth bringing into my network or anyone like me. So just think through those things in the lens of the deal triangle, and that's your homework for today. Hope this was helpful. We are going to do at least 2 more Raising Capital series. I got a lot to say on this subject, so stay tuned.